Historically, the stock market hands you like a 10% return every single year. But somehow the average investor only walks away with maybe 4 or 5%. So today we're doing a deep dive into Benjamin Graham's investing philosophy to figure out exactly how we're sabotaging our own wealth.
It really is a massive paradox. I mean, you are literally leaving half your potential wealth on the table. And the culprit isn't, bad stock picks or terrible market timing. It's actually our own human behavior.
We're the problem.
Exactly. We set these invisible emotional traps for ourselves, and then we step right into them.
Okay, let's unpack this. Is this entirely driven by us just, panicking when things look bad?
Well, panic is half of it, but greed is the other. Think about the classic rule of buy low, sell high. In reality, our emotions force us to do the exact opposite.
Because of the hype.
Right. When markets are surging, optimism turns into greed. Retail investors get fear of missing out, FOMO, and they pour money in right at the absolute market peak.
And then it crashes.
Yep. A correction hits, the market drops. Fear completely takes over, and they pull their money out at the exact bottom.
It's like going grocery shopping when you're incredibly starving. You make these impulsive, terrible choices based entirely on how you feel in that exact second.
Precisely. You let the feeling dictate the action. And that emotional volatility leads right into another massive wealth destroyer, which is overtrading.
Active trading.
Yes. Every time you hit the buy or sell button, you incur costs. You pay commissions, taxes, and something called the bid-ask spread.
Which is basically the hidden fee between what a buyer wants to pay and what a seller will accept, right?
Exactly.
Right, so it's death by 1,000 cuts. But wait, shouldn't a smart investor be taking action to capture gains? I mean, if I'm just sitting on my hands, aren't I missing out?
What's fascinating here is that action is actually the enemy of returns.
Wait, really? That feels incredibly counterintuitive.
It does, but every single trade is just another opportunity to make an irrational, emotionally charged decision. The data clearly proves that the least active investors consistently beat the most active ones.
So constant tweaking isn't strategic, it's just us getting in our own way.
Yeah, and it usually comes from a dangerous place, confusing a lucky bull market with your own genius.
Oh, everybody's a genius in a bull market.
Right. After a few wins when everything is going up, people think they have a special talent. They take bigger risks and stop doing the actual analytical work.
Which is crazy because even professional fund managers fail to beat the index most of the time.
They do. They can't even outperform a basic unmanaged basket of top stocks like the S&P 500.
That overconfidence has to be blinding. Like, if you think you're a genius, you probably stop looking at what you're actually paying for a stock.
Exactly. You start ignoring valuation entirely. People forget that buying a brilliantly run company at the wrong price is a terrible investment. Take Amazon in 1999. Great company, right. But its stock price had completely decoupled from its actual underlying profits.
People were just buying the hype.
100%. And if you bought at that peak, you lost 90% of your investment in the subsequent crash.
Wow, 90%.
Yeah, and you had to wait a full decade just to break even.
Here's where it gets really interesting. Because the entire environment around us feels designed to feed that exact cycle of overconfidence and panic. I mean, we are surrounded by 24/7 financial media that treats every single event like a crisis.
Right, because financial news isn't designed to make you a better investor. It's designed to keep you watching.
Yep.
They scream that the Federal Reserve raised interest rates, which, just means borrowing money gets a bit more expensive for companies. And they tell you to sell everything.
Or a company misses earnings by 2 cents and suddenly everyone is panicking.
Exactly. Wall Street guessed they'd make $1 per share. They only made 98 cents. And it's treated like a catastrophe.
So they manufacture urgency to make you click, watch, and act.
And as we established, action destroys your returns.
So what does this all mean? How do you actually survive this gauntlet of your own brain and the media?
Well, the root of everything we've talked about is emotion overriding analysis. The ultimate fix is creating a written investment policy.
Like a rule book for yourself.
Exactly. Before you invest a single dollar, you write down your long-term goals, your time horizon, and strict mechanical rules for when you will buy and sell.
And you create this document when you are calm and rational.
Right. That way, when the market starts screaming at you and the panic sets in, You have a system that protects you from yourself.
Because you already made the decision.
If we connect this to the bigger picture, Benjamin Graham proved way back in 1949 that humility in systems beat confidence and action every single time.
Because the mechanics of the market haven't changed.
Because human nature hasn't changed.
Yeah, it really makes you think about the invisible forces shaping our choices. If the 24-hour financial news cycle is specifically designed to make you act impulsively and destroy your long-term wealth, what other daily information diets are secretly sabotaging your long-term goals in life?